I'm Dr. Philip Gibson, Assistant Professor of Finance at Winthrop University, and today I'm here to talk to you about the basics of investing. We'll be covering the difference between a stock and a bond. First, let's start off with a stock. A stock is an investment instrument that represents an ownership in a company. When you purchase a stock, you are essentially purchasing a small part of that company. As a stock owner, you have a claim against the company's assets. Now, there are essentially two ways in which an investor can earn money from a stock. The first is capital gains, which is where you buy a stock and hopefully over time the price of the stock will go up. If at that point you sell the stock, that will be your capital gains. The next way you can earn money from investing in a stock is by dividend income. So in other words, whenever companies have excess resources, they can either reinvest it into the company or they can pass it on to you, the stockholder. So first, let's look at an example of capital gains. So let's say there's a company, let's call this company XYZ Corporation. XYZ Corporation currently trades at $10 in the stock market. You go out and you purchase a share for $10. 1 year later, the price of XYZ in the market is $15. If you decide to sell this stock for $15, your capital gains will be the difference between the selling price, $15, and the purchasing price of $10. Therefore, you'll have a capital gains of $5. Now, one thing to keep in mind, that in the US, if you hold a stock for greater than 1 year, you will receive a special capital gains tax rate depending on your income bracket. Now, investing in stocks doesn't come without risk. Just like in our previous example where the price of the stock went up, the value of that company could easily go down in the market. So let's say, for instance, instead of XYZ going from 10 to 15, let's say the stock went down to $7. And if after 1 year you decided to sell it at $7, then you would have a capital loss of $3. It is because of the risk that is associated with investing in individual stocks that we always recommend that investors put together a diversified portfolio. Therefore, over time, we expect that the portfolio as a whole will appreciate or go up in value. A portfolio will consist of many different stocks. So, for instance, I'm sure you've heard of the saying, don't put all your eggs in one basket. It's the same thing. So you should have multiple stocks within your portfolio to help protect against risk. The next way investors can earn a return from investing in stocks is that of dividends. So let's look at our example of XYZ Corporation. So let's say that you purchase XYZ Corporation, and for the year which you hold XYZ Corporation, let's say that they decided to send you a check for $1. That dollar that you receive represents income from the company, and this is what we call dividends. Now keep in mind that not all stocks will pay dividends. If you'd like to start investing in stocks, then a good place to start is with a practice account. If you go online, there are a series of vendors that offer free practice accounts. If you're here on the campus at Winthrop University, we have a financial planning and investment club. So you can always come by my office, which is in Thurman 111, and we can get you signed up right away. Now, let's talk about bonds. Bonds are a way for companies as well as the government to raise money. If the federal government, for instance, would like to raise some money, one way is for them to issue treasury bonds. Corporations who would like to raise money without issuing additional shares or issuing stocks in the market are also able to raise money by borrowing it from investors. They're able to do so by issuing bonds. So a good way to think about a bond is like an IOU. When you purchase a bond, you're essentially lending money to a company. In return, that company is agreeing to pay interest, which in the bond market is known as coupon payments. Let's look at an example with our company XYZ again. So let's say XYZ decides that they would like to issue some bonds to raise money. Now XYZ is going to issue a 30-year bond. What this means is that for 30 years, XYZ is promising to make fixed payments to the lender. At the end of 30 years, XYZ is going to return the money to the lender. So here's an example. Peter decides to purchase bonds from XYZ corporations for $1,000. In return, XYZ agrees to pay 4% coupon payment. What this means is that XYZ is going to send Peter a check for $40 each year. Upon maturity, Peter would then receive the face value of the loan, which is $1,000, the price that he paid for it. It is important to note that Peter does not have to hold the bond for the full 30 years. However, he will be able to sell the bond in the market. Now, one thing to keep in mind is that the price at which he sells the bond might be different from the price that he purchased it. It could be higher or lower depending on the prevailing market rates. Typically, when bonds sell below their par value, we refer to these bonds as being sold at a discount. When they sell above their par value, we refer to them being sold as a premium. Typically, the par value on most bonds in the US is $1,000. Similar to stockholders, bondholders can earn their return in two ways. The first being capital gains, which means buying a bond and selling it at a much higher price. And the second form is interest income, which is the interest that is paid to them by either the corporation or the government entity to which they're lending the money. A good place to learn about investing in bonds is by joining the Financial Planning Investments Club at Winthrop. However, if you're not able to do so, there are a variety of resources available online. And that's everything we have today on stocks and bonds. We look forward to seeing you next time.